Our next project, or our next presenter is native to the Cosmos space, this project. We're going to be talking about Terra. So I never knew anything about Terra until I was doing some research as part of a project I was contributing to called MicroTick over the summer. When I learned what this platform was doing, it blew my effing mind. You'll hear a lot more about it, but Terra is a blockchain, Tendermint-based blockchain, part of the Cosmos ecosystem that's seen some pretty mind-boggling adoption in South Korea, and there's much more interesting things even growing out of it right now. So, Do, good to see you.
Okay, so maybe it'll be productive if I spend some time talking about Mirror Protocol and why it's interesting. So I'm just gonna share a screen. Okay, so at Terra, we run a set of algorithmic stablecoins that are pegged to real-world currencies like the US dollar, the Singapore dollar, the Korean won, and so on and so forth. And we recently launched a synthetics protocol called Mirror that wraps around 14 different tokens that track the price of US equities. So if you look at the types of things that you can buy with UST, which is our dollar pegged stablecoin, it's things like mApple that tracks the price of an Apple stock, Google tracking the price of Google, Tesla tracking the price of Tesla, and so on and so forth. So what's kind of really interesting is that these synthetics are sort of minted on the Terra blockchain, but they can be migrated over to places like Uniswap, for instance. So for example, if you go to ETH.mirror.finance, we've built a front end that wraps Uniswap. So for example, for the Tesla token, you can press this. And then it takes you to Uniswap's own native interface where you can purchase the Tesla token. Right, so it trades against Terra USD, but technically it can trade against anything else. Yeah, so and then you can also trade this on PancakeSwap, which I haven't had the pleasure of using yet, but yeah, my laptop is like 4 years old, so okay. Yeah, there's too many of these, but basically the idea is that we've sort of constructed a scheme whereby you are able to create synthetics that replicate a trading experience of what you would find on an equities exchange, like commodities exchange, and then we've taken this interchain to be supported on Ethereum, and then Binance Smart Chain, Terra, and then coming to some other chains like Solana fairly soon. So basically, some of the things that are interesting to use on top of these equities versus holding the underlying assets is, for number one, the ability to earn a very high APR on top of these things. So, for example, like the APR that you can get on holding like Twitter stock, for instance, is, let's say, 300%, right? Like 290% for Amazon, like 290% for an Apple. And if you compound these daily, so let's say that you earn APR in the form of the native governance token, which is called MIR, and then you sell half of it, and then you keep the other half, and then you put it into the MIR token pool itself, you can earn a really high APY. So I would say somewhere hovering around the realm of 2,000%. So basically, the value proposition becomes really interesting, whereby not only can you hold synthetic price exposure to some of the most attractive assets in the world in the form of US equities, but you can also earn a very high APY on them. So it's kind of, like the marketing slogan could be, get paid to hold Apple stock, which is, in my opinion, very attractive. So from a yield farming perspective, the ability to earn yield on holding real world assets is much more attractive than I would say the rest of the universe of yield farming opportunities. And the reason for that is, for example, if you're providing liquidity on a DeFi native token, let's say it's called the French fry token, then there's sort of no price floor. So like the price of the price volatility of the token is much higher, right? Like it shouldn't be surprising to you at all if the price of the French fry coin goes to zero, or if it spikes like 10x for no reason. So basically, the yield is high, but it's only high to compensate for the very high risk of impermanent loss. But for Microsoft stock or for like Netflix stock or Apple stock, volatility is there, but it's definitely not at a scale of what you would expect from some of the smaller coins in DeFi. So that's something that's worth considering. Okay, so we're building some exciting things on top of Mirror. So for example, there's a bunch of things that are coming up on top of the Mirror protocol. So for example, there's a project being built out called Spar Finance. So basically, the idea here is that it's a decentralized fund management protocol, whereby fund managers can construct sort of, shall we say, signaling wallets that invest into public markets and Mirror. So investing into synthetic stock markets. And then, community members can sort of attach their wallets to the Spar fund wallet, and then basically have these fund managers, allocate their portfolio into different projects in a totally non-custodial manner. And in exchange, a certain percentage of the fee, management fee, or some carry that you make on the that the fund manager makes on behalf of you, can be paid out to the fund manager in the form of, so let's say, a thank you. There's different things that's being built out, like an ETF product, a dynamic ETF product, whereby a smart contract determines the rebalancing of the assets in the pool. There's also, like a bunch of new assets that are looking to get listed. Yeah, so really interesting things that are being built up on top of these things. Okay. Yeah, so that's pretty much coverage of Mirror protocol. It's a pretty interesting application of what you could do with synthetics. And we're looking to get these built out in more chains. We're looking to expand the asset coverage that we have by having Mirror protocol cover the wide gamut of different types of equities, commodities, and ETFs. So basically, you're going to start to see a mirrored version of NASDAQ on these things. And then the new products that are going to be built here is going to sort of expand the functionality of these mirrored assets, such that you can do more with these assets than you could ever do with the underlying equivalents. Okay, yeah, so that's just about it on what I wanted to cover. If I had known this was a presentation, I would have said more. But
cool. Well, we could just do some like spontaneous Q&A, I suppose. Let's see if anybody has any questions or comments here. Somebody's saying, can you explain how you'll fix the premium price on mirrored assets?
Yeah, are there questions or oh, okay, cool. Yeah, so right now, most of the mirrored assets are trading at a premium to what their underlying prices are. And then the premium gets much worse when markets are closed versus when markets are open. And that's because there's no arbitrage loop to close things out. So the reason why mirrored assets trade at a premium is because number one, mirrored assets have a significantly higher cash flow from dividends. So, and what I mean by this is from yield farming. So it makes sense that they, from a discounted cash flow perspective, that they be worth more than the underlying asset. right? And then number two, the underlying stablecoin that gets used as collateral to create these M assets, which is Terra USD, is currently trading at a premium. And so that premium gets reflected in the mirrored assets themselves because they are a derivative of Terra USD. So a couple of things. Number one, we're going to be solving the Terra USD premium issue starting from next Tuesday, because at Terra, we sort of recently passed a governance proposal to make the minting parameters for Terra USD much more significant, to a magnitude of 20x. So once Terra USD premium subsides, then in that case, it's going to make it much easier to sort of ameliorate the premium issue on the M assets as well. That's one thing. Number two, we're sort of tweaking the incentive mechanism a little bit on Mirror, such that it becomes more incentivized for people that are looking to arbitrage price differences between underlying and the M asset, even when the markets are closed. So once that mechanism is out, tentative timeline early March, I think the situation should be much better.
Cool. Speaking of the token, somebody's wondering, James Fox is wondering, what is the inflation of the Mirror token currently?
Let's see. So for year one, it should be around 100%.
Okay.
Yeah, and then after that, it should diminish to, let's say, 20%, 10%, until it reaches a fully diluted supply of 370 million tokens.
Right. Okay. And then another question: what about the leverage for the liquidity?
Yeah, so we've recently made a proposal on Cream Finance to get mirrored assets added to their lending markets. And what this is going to enable is that we'll be able to get this into alpha. So in that case, yeah, you could do leverage yield farming on alpha tomorrow.
Great.
Which apparently is attractive. Yeah.
I have a question that I would suspect is on the minds of some viewers right now, is in terms of how this relates to Ethereum. Currently the vast majority of DeFi liquidity is over in the ETH space. How does Mirror, and maybe this relates to Terra's plans as well, but how do you guys plan on bridging over to sort of network with that wonderful giant big ass liquidity pool over in Ethereum land?
Yeah, so one of the interesting things that we noticed is, okay, so we created a bridge called Shuttle to bring over Terra USD and these mirrored assets over to Ethereum. And then Terra USD is starting to become pretty well integrated into lots of places in the DeFi stack on Ethereum. So for example, it's on an incentivized Onsen pool in SushiSwap. It's on Uniswap, it's on Curve, trading against USDC and Tether. And it's on places like Harvest Finance and lots of different places. And then a similar situation for mirrored assets. And what's kind of interesting is that if you have incentivized pools on both Ethereum and Terra, we're starting to see a lot of transactions cross over into a chain that is more affordable. Because if you're going to be trading these assets regularly anyway, right, people are willing to sort of take the jump into try to trade in a system where it has a lower cost basis. I mean, for some of the guys, like it doesn't fit their security model, or for stickiness and various different reasons, they will stick around. But in other cases, yeah, crossover has definitely, we were definitely able to see that. So in terms of the total number of transactions, on a daily basis, we're seeing about 16,000 transactions on Terra. And then maybe just a couple thousand on Ethereum side for Mirror. So, yeah.
So by way of comparison, what was that figure, say, maybe 3 months ago? Or I guess the protocol is pretty new, so it's hard to have historical data.
Yeah, it's only 2 months old, so we don't really have any of that.
Up and to the right, right?
right, yeah.
Menno PP is wondering, should I stake my Mirror? Put it into LP for the best returns?
Yeah, great question. So if you believe that the price of Mirror is going to stay relatively stable, so for example, you feel like, towards the end of the year, it's going to be worth more than a third of what it is today, or worth less than 3x of where it is today, then you should you should you should put it into an LP pool, so Mirror against UST. But if you feel like it's going to be highly volatile, then you should put it into the governance staking, which also offers up to almost 100% APR.
Cool. Geisha is wondering, can you explain why Terra doesn't want the on-chain Luna stablecoin swap used, besides as a way to control stablecoin price?
Yeah, so that's a good question. So for sort of like a background there, how Terra stablecoins maintain their stability is that they so at any given time you can trade in stablecoins against the system for whatever their nominal value is in the Luna token. So in essence, the protocol acts as a price maker for the stablecoins using the Luna staking token as the medium. So for example, you can always trade in 1 Terra USD against the system to get $1 worth of Luna in return. So which means that when the stablecoin is trading at 90 cents, you can buy from the open market, get $1 worth of Luna, and then sort of keep doing this arbitrage until the price stabilizes. So it's not so much that we don't want this swap mechanism used for anything besides stabilization. It's just that a lot of the times in which swap mechanisms are being used, there are lots of cases in which it can be exploited at the cost of somebody who's holding Luna. So for example, in a situation where the prices of the coins are stable, but a lot of people are, let's say, swapping the stable coins for Luna instead of buying it from the open market, then in that case, it's a way to dilute Luna supply, because Luna gets printed as more Terra swapped in, right? Without sort of having to pay the slippage cost and therefore the price increase that you would get if you were trading the open market. So, obviously that's something that isn't value constructive for the ecosystem.
Cool. That's a great nuanced answer. Thank you. Esquire 13, can you explain Anchor and thoughts about when it'll be released?
Yeah, so Anchor is a pretty interesting product where we attempt to get pretty close to what is a fixed income instrument. So the way that we've designed it is it's very similar to let's say a federal funds rate, for instance. So for example, people that are holding the Anchor governance token can set a target interest rate or on what they want Anchor to produce. And then basically how the system works is that so basically in the background, there's a money market where staking positions across different ecosystems are being leveraged to earn yield to power interest rates on deposits. So when the staking reward revenue is in excess of this target rate, then we're fine. So in that case, we just give out the fixed income, and then we keep the rest as some sort of buffer to pay for future interest dividends once we run out. And when the interest rate falls below the target rate, then in that case, we dip into the reserves that we built up during times in which we were making excess. And if the demand falls even below that, i.e. we've spent everything in the reserve, then in that case, incentivization schemes in the Anchor governance token is used to bring borrow demands back up. So in essence, what the system tries to do is that it tries to use a set of monetary levers, some of which rely on the monetary policies of various staking systems, to try to get to a target interest rate that the community deems feasible to be paid out in stablecoin. So I think this is pretty exciting because we've never really had a scalable fixed income instrument in crypto. And if you have such an instrument, it becomes very useful to plug into lots of different DeFi primitives. So, which is why we try to target Anchor as, sort of like a gold standard or reference interest rate in crypto, similar to what you would find in a federal funds rate that sort of animates the US dollar. The launch schedule is we're going to be launching with so B2B partners. So we're wrapping this up into an SDK and then sort of exporting it such that it can be hooked up into lots of wallets and fintech services. So it should be in a matter of weeks. So definitely in February. And then we generally, for everything we ship, we try to airdrop Anchor governance tokens to people that stake Luna. So pretty bullish on that too.
Cool. Yeah, it sounds like you guys have really thought through the economic incentives, the tokenomics, edge cases. You mentioned security, though. Can you speak a little bit to the challenge of building a separate validator set for a new zone? Did you sort of leverage your existing validator set and do outreach to what you had with Terra? I know from working on building a validator set with MikroTik, it's tricky. You want to make sure that it's really distributed, and it's one of those trade-offs. You can't just rely on the wonderful shared security of ETH. Did you find that to be a fairly straightforward thing, leveraging your cred with Terra?
Yeah. So both Mirror and Anchor are built on top of Terra. So we have a sort of a WebAssembly virtual machine, called Cosmwasm, which was built by the good folks at. Yeah. So basically, it's basically a set of smart contracts. But when we were first launching Terra, I think it was a little bit easier to bootstrap the validator set, because we were the first zone besides the IrisNet to launch out of the Cosmos ecosystem. So I think a lot of Cosmos validators were sort of, more enthusiastic about joining a zone just to understand what the experience would be like. But now that there are lots and lots of different zones that are popping up, I think it's more challenging to bootstrap a set.
Yeah, it makes sense. Let's see here. We have time for a few more questions. Let's see. Bigger architectural difference. Swiss David is wondering, how would you explain the differences between Ethereum and Terra? This touches on some kind of high level, like we were just talking about with shared security. But one big difference is it's not super freaking expensive right now on Terra. But yeah, it's kind of high level stuff. But what would you say are the big differences there?
Yeah, so just in terms of philosophy, like Ethereum used to be a sort of like a decentralized computer that is sufficiently general to be able to service most types of use cases that you want to build. So the idea is that Ethereum is sort of like the decentralized AWS, and then ETH, the reserve currency that gets the reserve and the gas currency that gets used throughout this ecosystem. So for Terra, the goal, it's more of it has a very strong fintech vibe. So the idea is that we would want to take, the good parts of what animates blockchain technology, and then think about how we can use these technologies to solve problems that everyday users come across in finance. So for example, if we have constructed a set of stablecoins, the problems that we think about is how can we make these stablecoins easier to spend? So for example, how can we make use the decentralized nature of these stablecoins to improve pain points in legacy payments technology in a way that other players cannot? Or how can we make the trading experience or the ability to buy asset exposure in different places across the world much easier by using decentralized synthetics? And how can we come up with an uncorrelated savings rate by tapping into a vast reserve of yields in decentralized finance and on Ethereum, and then bring it to lots of people in the world that are not making a real interest on their savings, and therefore sort of demolishing their household savings as a result. So I would say that it's a difference between sort of a sufficiently general machine and then sort of like a fintech ecosystem that is powered by DeFi.
Very cool. James Fox has a great question. Do you guys have plans to expand, this is more, I think, Terra related, expand payment outside of South Korea?
Yeah, so great question. So I think the ability to pay in different types of crypto is going to be commoditized over the next couple of years. So with Visa offering crypto payments, PayPal, Venmo, those will all, right now they only allow the ability to purchase in Bitcoin, but they're going to expand into different types of payments use cases, I think, in the latter half of this year. I think where Terra is a little bit different is that on most of the different payment services, they sort of try to focus on exposing the crypto to the consumer and the merchants to fiat. So for all of these different services, it allows the user to top up in crypto. And then always the settlement piece with the merchant is in terms of fiat. We're actually the opposite. So if you look at Terra payment services, the consumer side of the engine is always abstracted. So they generally like to top up in either their bank account integration or with fiat directly. And then the settlement to the merchant comes in the form of crypto. I think this has some massive benefits, like for example, the ability to settle faster or for cheaper. And I think this is sort of like a use case that resonates through most places in Asia. But like in 2020, had things gone normally, we should have expanded to more places, but license acquisition and the ability to talk to regulators becomes difficult during a pandemic. So I think as the situation ameliorates a little bit, I think we'll be able to be a little bit more aggressive on expansions.
Right. A few users are wondering if you're drinking wine. I don't know about you, though, but we're about to start drinking beer here at ETHDenver headquarters.
Yeah, it's 8 a.m., but I'll join you guys.
The answer is probably no, guys. Great. Yeah, I guess it's time to wrap up. It sounds like some users might have more questions in the comments, though, if you want to jump in those. And as far as just learning more, the latest and greatest, I know you're pretty active on Twitter. Mirror Protocol, is it Mirror Protocol, or is it Mirror.protocol for the website, or? Yeah,
so if you go to mirror.finance or anchorprotocol.com or Terra.money, there's a set of community links. I'm pretty active in all of those. There's also my Twitter, which is D0H0K1. So if you send me a DM, would happy to chat. Thanks for having me today.
Yeah, thanks for stopping by. Good to see you, and have a good one.
Yeah, bye-bye.
Okay. Yeah, if you guys want to see an example of like a project and a platform that's iterating really fast, I think that's a good one. And Terra was interesting enough. Now that they've added Mirror, it's really getting far out. And then I saw one of the comments having to do with mirroring U.S. equities. This is an interesting question from a lot of standpoints, regulatorily, from an Oracle standpoint. So keep an eye on what they're doing with that too, because they're one of the projects that's really pushing the boundaries. And I think inevitably we'll probably see some, and I think Bill alluded to this, but some of the those mirror native assets pegged over to ETH on the ERC20 side, and then wow, they're on Uniswap, and holy crap, anybody can get them on Ethereum, and it gets very interesting from there.